Warren Buffett is known worldwide as one of the most successful investors of all time. As the longtime CEO of Berkshire Hathaway, Buffett has built his company into a behemoth worth hundreds of billions. Through disciplined value investing principles, Buffett has achieved an average annual return of over 20% for decades. Given his track record, anytime Buffett issues a warning about a potential problem brewing in the market, investors would be wise to take heed. In the video titled Warren Buffett, a storm is brewing in the real estate market.
But it all has consequences, and I think we are starting to see the consequences of.
The Oracle shares his concerns about real estate based on economic indicators and historical patterns. With prices at all-time highs and interest rates rising, Buffett believes conditions are ripe for a correction. While the prospect of a major downturn is unsettling, understanding Buffett's logic can help investors and home buyers prepare. By examining how past bubbles formed and burst, one can gain insight into the current landscape and position themselves accordingly. Rather than panic, using Buffett's sober analysis as a guide allows for making prudent decisions with eyes wide open to risks. Before we start our real estate adventure, make sure to give this video a huge thumbs up and subscribe to our channel. The history of housing booms and busts. To grasp Buffett's message, it's essential to review the typical progression of real estate cycles. Time and again, extended periods of rising home values have given way to sharp declines. After World War II, the booming post-war economy fueled unprecedented demand. With few options for investing one's money and strong employment, people poured funds into residential properties. This spurred a massive run-up in prices nationally from the late 1940s into the mid-1950s. At the peak, homes were valued at nearly 7 times median annual family income. But when interest rates rose in the late 1950s under the Eisenhower administration, it pricked the balloon. Home values plunged over 25% between 1956 to 1962 as affordability worsened. A similar story played out during the 1960s and 1970s as well. Low interest rates and abundant lending fueled speculative investing, driving the median price-to-income ratio above 5 times by 1978. Yet when Paul Volcker jacked up rates to halt runaway inflation, housing crashed with values sinking by almost 30% from 1978 to 1982. Many were left owing more than their homes were worth. Then came the greatest housing boom in modern history during the 2000s. With mortgage underwriting becoming lax and rates at generational lows, funding flooded into real estate. At the peak in 2005 to 2006, the median home price reached nearly 5.3 times median family income. But as subprime loans began defaulting, foreclosures skyrocketed and the financial crisis ensued. Housing slumped more than 25% nationwide, with some Sun Belt markets hit over 50%. Each cycle followed an eerily similar pattern. Extended periods of falling rates and loosening credit standards inflated home valuations to extreme peaks, beyond historic norms. But as economic conditions shifted and lending policies tightened, affordability deteriorated rapidly and the bubbles burst. Most experts argue we're due for a correction again, and Buffett warns the ingredients are falling into place. Interest rates are rising from all-time lows. The Federal Reserve has progressively hiked rates over the last year in response to inflation, with mortgages following suit. The average 30-year fixed rate has jumped from 3% to over 7% presently. This makes homes significantly less affordable by increasing monthly payments substantially. Those who purchased recently hoping rates would stay low now face much higher costs. Further Fed tightening could tip many current owners into negative equity. Loose lending drove speculative buying. During the easy money period from 2020 to 2021, Wall Street investors and all-cash buyers flooded the market. Some purchased 10 or more homes solely for rental income. Meanwhile, lenders relaxed standards to keep momentum going, instituting low or no down payment programs again. Such speculative demand inflated prices rapidly, but also introduced instability. Should vacancies rise or cap rates worsen, investors may dump properties en masse, flooding supply. Those with small or no equity stakes become prone to strategic defaults as well. All the hallmarks that presaged past market downturns have re-emerged according to Buffett. With rates still below historical averages, but moving sharply higher, a painful adjustment may begin unfolding unless conditions change dramatically. Naturally, the implications demand careful consideration. Navigating a potential slowdown. Rather than panic, Buffett's advice aims to raise awareness so all parties can make optimal decisions facing uncertainty. For current homeowners, the key is understanding one's individual circumstances and options. Those who own homes they can afford long-term need not worry short of job loss. Rising rates may lower resale values, but housing serves as shelter first. Those with high loan-to-value ratios or adjustable rates would be wise to refinance fixed while qualifying. Locking in a lower payment protects against rising costs. Renting remains a sensible alternative to overpaying at market tops and offers location flexibility if job prospects change. Timing large investments poorly has real costs. As for investors, Buffett advises caution given high valuations and economic headwinds on the horizon. Rental yield spreads have compressed, while cap rates sit near historical lows according to several real estate indices. Better opportunities may exist once turbulence passes. Warren Buffett aims not to stoke panic with his timely warning, but to encourage sober assessment of risks from an expert with a proven track record. The Oracle believes real estate again shows signs of a cycle grown long in the tooth based on fundamental indicators and history. Prudent individuals would be wise to understand their situation and leverage Buffett's wisdom to make optimal choices despite uncertainties ahead.